Okay, let's jump right into this explainer. I want you to imagine a company that boasts a price-to-earnings ratio of just 9.7. They've got an elite return on equity of 23%, meaning they are incredibly efficient with shareholder money, and they're sitting on an absolutely massive mountain of cash, totaling $491 billion. Add in a wide moat rating from Guru Focus, and honestly, it sounds like an absolute no-brainer deep value buy, right? But here is the massive catch. Their profits recently collapsed by 15%. They just swallowed a colossal $1.5 billion regulatory fine, and the stock, it's plunged 35% from its highs. So today, as investment analysts, we are putting PDD Holdings, the massive parent company behind e-commerce giants Pinduoduo and Temu, under the microscope. And that brings us to the core paradox of our analysis today. We are looking at a colossal global player. They have a total fortress of a balance sheet and historically elite profitability. Yet somehow, the market has completely turned its back on them. PDD is down roughly 20% year-to-date and 35% from its 52-week high of $139. Right now, it's trading right around $90 a share. So we really have to ask ourselves, are we looking at a once-in-a-decade bargain here, or is this just the ultimate value trap?
To start, let's run a quick comparable company analysis. PDD is trading at a microscopic price-to-earnings, or PE ratio, of just 9.7 times earnings. The rest of the e-commerce industry, they're sitting way up at an average of 25.7. That is a staggering 62% discount. You are literally buying their sales for pennies on the dollar with a price-to-sales ratio of 0.27 and an enterprise value to revenue that's almost negligible at 0.10. But look, the market doesn't just hand out discounts like this for no reason. To solve this mystery, we have to investigate the systemic risks that are actively breaking down the bull case.
Section 1. The hidden red flags.
The sheer velocity of their current slowdown is pretty shocking. Back in 2023, PDD was posting 90% revenue growth. In 2024, it was still a very solid 59%. But then, someone slammed on the brakes. Growth fell to 9.7% in 2025, and analysts are projecting it'll hover around just 11% for 2026. This isn't just a blip, it's a structural slowdown. To make matters worse, Goldman Sachs is actually projecting their adjusted net profit for 2026 will be exactly the same as 2025, around $15.2 billion. That means 0% earnings growth. For any stock, but especially a former hypergrowth darling, the future suddenly looks absolutely nothing like the past.
And then we hit this jaw-dropping figure. In April 2026, Chinese regulators handed down $3.6 billion in fines across 7 different platforms. PDD ended up taking the absolute brunt of it with a $1.5 billion penalty. But honestly, it's not even just the money, it's the justification behind it. Regulators literally stated that PDD repeatedly refused to provide required materials and used violence to obstruct regulatory enforcement. Think about that. That is a shocking accusation. This isn't just your standard cost of doing business. It signals profound governance and compliance red flags that institutional investors just cannot ignore.
Unfortunately, the hits just keep coming. We saw a 15% net profit collapse recently, a 45% miss against analyst expectations of $2.28 billion, coming in at just $1.85 billion. On the international front, the EU slapped a €3 fee on low-value e-commerce packages, which is a direct, targeted attack on Temu's high-frequency, cheap shipping business model. To counter all of this, management just launched a $15 billion strategic investment plan to build a first-party brand. Now, while that might be necessary, it practically guarantees their margins are going to be squeezed for years. Combine all that with the fact that insider ownership is essentially zero, between 0.05% and 0.10%, and management pays zero dividends. They have virtually no skin in the game, and income investors get absolutely nothing for waiting. But before we completely write this stock off, we have to abruptly swing the pendulum back. Because as terrifying as those red flags are, the bull case is equally extraordinary.
Section 2. The extreme green flags.
Here is your ultimate shock absorber. $491 billion in net cash. Against just $5.4 billion in debt, PDD is holding cash reserves that represent an unheard of 380% of their own market cap. Let that sink in. This makes PDD one of the most conservatively capitalized companies on the planet right now. This massive vault of cash acts as a giant financial cushion against the exact regulatory and competitive threats we just finished talking about.
Underneath all the regulatory noise, the fundamental business engine here is still elite. They are generating a 23% return on equity and an 18% return on invested capital. The price to free cash flow is a staggering 1.68, which implies an almost 60% free cash flow yield. In plain English, that means they are generating massive amounts of actual cash relative to what their shares cost. And if you run a standard discounted cash flow or intrinsic value model, Guru Focus actually calculates their fair value at $202 per share. With the stock hovering near 91 bucks, that implies it is significantly undervalued, offering a massive 55% discount to intrinsic value.
When evaluating their economic moat, Guru Focus grants PDD a wide moat score of 7 out of 10, putting it in the top 0.8% of companies. That strength comes directly from incredibly powerful network effects. We're talking 900 million users in China and a world-class supply chain that directly bridges small farmers to urban consumers. But as we know, this moat is under siege. Regulatory fines, intense domestic competition from heavyweights like Alibaba and JD, and mounting international trade barriers are attacking the perimeter. It's a classic wide moat business facing the ultimate real-world stress test. So, to objectively evaluate this incredibly messy reality, we need to run PDD through a true value synthesis.
Section 3. The Guru Gauntlet.
Let's step into the frameworks of 3 legendary investors to see how they'd grade this, starting with the father of value investing himself, Benjamin Graham. Based on our data, Graham's hypothetical verdict would be an enthusiastic buy. The price-to-Graham number ratio right now sits at a historical low of just 0.84. Whenever a stock trades below 1 on this specific metric, Graham sees a massive margin of safety.
If we run straight through Graham's defensive investor checklist, PDD actually passes with flying colors. Is the PE under 15? Yep, it's 9.7. Is the debt to equity well managed? Yes, it's incredibly low at 1.21%. Most importantly, using Graham's strict intrinsic value formula, we calculate a fair value of approximately $91. With the current price sitting just pennies under that at $90.94, the math is incredibly tight. It perfectly fits his demand for a heavily discounted, cash-rich balance sheet.
Next up in the gauntlet is Peter Lynch, the absolute master of finding growth at a reasonable price. His hypothetical verdict? A very firm wait. See, Lynch loves a great growth story, but that zero growth projection for 2026 we mentioned, it completely breaks his primary valuation tool, the PEG ratio. The PEG ratio is just the PE divided by the growth rate. If you try to divide a low PE by zero growth, the math simply falls apart.
Lynch categorizes companies very rigorously, and right now, PDD has essentially had its fast grower status revoked. His main concerns would center on the sheer unpredictability of the business moving forward. Between the regulatory hammer, the new EU tariffs, and the fact that the stock is trading 20% below its 200-day moving average, the momentum is fundamentally broken. Plus, that near-zero insider ownership we talked about, he hates that. Lynch would demand clarity on future earnings predictability before taking any kind of position here.
Finally, we bring in Warren Buffett. The Oracle of Omaha's hypothetical verdict on PDD Holdings would likely be a partial fit. He would absolutely respect the fortress balance sheet and the elite profitability, no doubt about it. But the overarching geopolitical narrative, that would give him some serious pause.
Let's break down his specific criteria. PDD totally crushes Buffett's profitability tests, an ROE of 23% and a return on invested capital of 18%, both well above his 15% minimum threshold. He'd also really love the 8 to 9% owner earnings yield, which easily clears his 5% requirement. However, Buffett demands durable, predictable economic moats. He needs to be able to accurately forecast free cash flows 10 years out in a DCF model. Because PDD's future relies so heavily on navigating completely unpredictable Chinese regulatory crackdowns and global trade barriers that are totally out of management's control, that crystal ball is shattered. He'd likely deem it just a bit too speculative for a core holding. So let's bring all this conflicting data together.
Section 4. The final verdict.
So, we're left with a split decision. Graham says buy for the deep margin of safety. Lynch says wait until the growth picture actually clears up, and Buffett sees a partial fit, but warns heavily against the unpredictability of the moat. This perfectly encapsulates PDD as the ultimate deep value with deep risk situation. You have these exceptional financial metrics and a deeply depressed valuation, but they're shackled to severe, completely uncontrollable geopolitical and regulatory threats.
If you are watching this story unfold, you need to mark this timeline on your calendar. August 24th, 2026. That is the estimated next major earnings date, and this report is going to be the ultimate catalyst.
It will finally provide the necessary clarity to prove whether that recent 15% profit decline and the massive $15 billion strategic spending plan are just temporary bumps in the road, or if this structural decline is permanent.
Which leaves us with the ultimate question to close out our analysis today. When you weigh the incredible, undeniable buffer of $491 billion in net cash against the existential threats of international tariffs and domestic regulatory crackdowns, is this 35% decline a once-in-a-lifetime bargain for those with an iron stomach, or is the risk simply too high? It is a fascinating puzzle of modern value investing. Take these frameworks, run your own discounted cash flow models, dig deeper into the numbers, and decide for yourself. Thanks for joining me on this explainer, and keep learning.